Hey guys, Reese here and welcome back to my channel. So I love real estate and I'm pretty sure that's obvious to anybody who's watched my channel before. And while I strongly believe that anybody can get into real estate, no matter their income, credit, money in the bank, whatever, I understand that it's just not that interesting to a lot of people, or they just have no desire to own real estate of their own. And by the way, those of you wondering, how do I get into real estate with no money, no credit, no lendability? Well, the secret's a partner, really. So you obviously need to partner with somebody with strengths that you have weaknesses in. So for example, you have no money, you need money. You bring the time, the sweat equity, find a great deal, bring it to an investor. You will have no trouble, especially in today's market, finding an investor willing to partner with you while you do the work on that property, especially if you found the deal and it's a great deal. But that's a different video. Let's get back to the topic of today's video. What should you do if you want to invest in real estate, but you don't want the hassle, you don't want the liability of owning physical property, and you don't have much money to get started with either? Well, the answer to that question is investing in REITs. And so in today's video, we're going to talk about what a REIT is, the pros and cons of a REIT, and how you can get started investing in a REIT and therefore in real estate with very little money. We're talking $5, $10, $100, not much at all. But before we go ahead and talk about that, guys, I'd love it if you'd like this video. And while you're at it, if you're new to the channel, go ahead and give me a subscribe. I'd really appreciate it. And it helps me out a ton. So thank you so much. Let's get right back into the video. So first off, what is a REIT? Well, a REIT is a real estate investment trust, which is exactly what it sounds like. It's a company that invests in real estate as the underlying asset. And they usually focus on one specific area. So for example, a REIT that focuses on multifamily would buy 200-300 unit apartment buildings and then go ahead and operate those, manage those, and provide profit back to the investors. And now the REITs that we often hear about or we see on the stock market are publicly traded REITs. And so they're just that. They're REITs that are traded on the stock market. And so you can buy and sell stock in these companies. And like I said, there are multiple different specializations or areas of focus these REITs will adhere to, such as they'll purchase multifamily property, or you'll have another REIT that only does industrial or office or maybe retail. And you also might have some that diversify between mixed use, multifamily and retail, or office and retail, things like that. And so you can buy into these REITs the same way you'd buy into any other company in the stock market. You purchase stock through a service like Webull or Robinhood, which, by the way, if you guys are looking to get started investing in REITs or in the stock market in general, I have links in my description for 2 free stocks with Webull or Robinhood. So if you're interested in getting started with those, go ahead and click the link down below and those will give you the free stocks. And those are both great platforms to get started using to buy both REITs and stocks. So by buying stock in a publicly traded REIT, you're therefore entitled to a portion of the profits of that company. And when we buy small rental property, I call it cash flow, and that'll be paid out to you in the form of a dividend. Now, in order to qualify as a security, a REIT has to pay out 90% of its net income, or pretty much its profit. And the cool thing about that is that if it pays out at least 90% of its net income, it qualifies where it doesn't have to pay corporate tax on those net earnings that it pays out, unlike other companies where they have to pay tax on that profit. Anyway, now that we pretty much know what a REIT is, or at least the general idea, let's talk about some of the benefits or the pros of buying stock in a REIT. So the first is that there's an extremely low barrier to entry. And this really comes in 2 parts. So if you invest into a REIT through Robinhood, you can invest using fractional shares. And fractional shares through Robinhood allow you to invest as little as $1. And so you can get started investing in these different REITs with as little as $1. But in general, you can buy 1 share as well, and share prices of REITs range from $10 up to hundreds of dollars. But the point is, very low barrier to entry when it comes to the dollar amount you need to invest. And therefore, you can go ahead and get started investing in REITs with that $20 bill that you got for your birthday last month. In addition to price, there's no barrier to entry when it comes to buying or selling. It's as easy as buying or selling any stock on the stock market. You press buy or you press sell through Robinhood. The second benefit is that there's no management headache of buying into a REIT, and therefore it's 100% passive. Now, I've stated this many times in my past videos, but buying into real estate that you own and operate yourself is by far not passive, especially when you're buying more and more property, you're trying to build your wealth and accumulate property, and maybe even execute a business plan adding value to that property. It's not passive at all. Now, the goal, or at least my goal, is to grow a portfolio that's large enough in size that I have property management take over, I've stabilized all the units, and therefore it becomes mostly passive, even though there still will be like an asset management that I'll have to do on a monthly basis, but it'll be mostly passive at that time. Well, that's not the case for a REIT. A REIT is 100% passive, just like owning stock in any other company on the stock market is as well. You have no responsibility. Therefore, you buy in and you're paid out a portion of those profits in dividends without having to do any work. Now, as you can all probably assume, by being passive, you're earning substantially less than you would if you actively invested in real estate. However, that's a trade-off that many people might be interested in when it comes to having 100% passive income versus working at all. Number 3 is that there's no liability. This comes in 2 parts as well, whereas in real estate, if you're purchasing, say, a duplex, most of us are not going to buy that in cash. We're going to take out a loan on that property and maybe put 5 to 25% down. Well, the only issue with that now is now you're liable for that mortgage and you need to pay that back over time. In addition, you could be, obviously you would have to consult a lawyer at that time, but you could be held liable for any injuries on the property, just really anything that goes down on the property. And so these are 2 areas that if you have a low risk tolerance or you're just not interested in taking on that headache that could come about from somebody getting injured on your property, even though, insurance would cover anything that happens on your property. However, point is, if you're not interested in that, by buying into a REIT, you have no liability at all. Number 4 is consistent and diversified returns. When you buy into a REIT, you're buying into millions of square feet of office space, thousands and thousands of units of multifamily, or hundreds to thousands of retail. And these properties are also usually not condensed into one location within the United States. Usually you'll be all over the United States in many different states. And so therefore your return is not reliant on one deal performing well or one business plan on a deal being executed well. You have hundreds of different properties making up the return that you're receiving in that dividend payout and stock price increase. Whereas if you were to buy a duplex, for example, well, your return is 100% reliant on that one property and those 2 units. So if you don't manage the property well, you're not going to make any money. Or, for example, if, say, that city or that neighborhood just goes downhill, well, your return goes downhill with it. In addition, REITs tend to buy stabilized, Class A, very, very large properties. And the reason they do this is they have billions and billions of dollars of assets under management, and they can't possibly handle the oversight or the overhead that comes along with, say, managing a value add deal or a distressed deal and executing value add to these. The benefit of owning Class A rental property is that they have very, very consistent returns, very, very consistent vacancy. All their expenses are, like I said, very consistent. And so therefore, your return is also consistent. Dividends are usually locked in a year at a time, so you know what to expect in your return for a year at a time. And then usually you'll have dividend increases each year if you're buying into a well-managed REIT. Whereas if, once again, you own a duplex like I do, well, if you lose a tenant, you might be vacant for a week, as well as you'll have unit turn costs and releasing costs. And so your return that month would be substantially lower than any other, or it might even cost you money. Let's dive into the cons now and talk about why I personally don't invest in REITs. First and foremost, the cash flow is paid out in dividends. Now, for REITs, cash flow is usually the primary return. Stock price doesn't go up and down that much unless there's large changes in the market, because the net profit is not really reinvested. It's 90% or more is paid out. So unless there becomes strong demand to buy into that REIT, the price could go up due to strong demand in the stock market for that particular stock. And of course, the underlying assets going up in value. However, that's usually what, 3 to 5% a year? It's not substantial. And so the majority of the return is usually paid out via dividends. However, dividends are taxed as ordinary income at your highest marginal tax rate. Now, of course, the same goes for rental income. However, you can write off depreciation against rental income. And so I won't go into that too much in this video, and you can talk to a CPA about depreciation on rental property. However, the general idea is you can, once again, depreciate or write off a portion of the asset value of the building itself on land and write that off against the income. And therefore, most years I break even or sometimes even lose money on paper due to depreciation and pay no taxes. Now, this is one major con of a REIT. However, it can be kind of offset by investing in REITs through a 401k or a Roth IRA, some tax advantaged account, and therefore those dividends won't be taxed. The tough thing here is that if you want to live off that dividend income to achieve, financial freedom, then you can't really invest through a 401k or a Roth IRA. Con number 2 is the inability to use leverage when purchasing a REIT. Real estate alone isn't that great of an investment. It has relatively low returns. Property values go up 2 to 5% a year, and then you have cash flow, which is maybe, 5 to 10%. However, what makes real estate so great is one, tax advantages, which we'll talk about in a second, and then also the ability to leverage your money and buy larger properties. And so therefore, you're not purchasing these properties cash. You can put 5 to 25% down and purchase a much larger property and therefore leverage your return as well. It's not unheard of to be able to earn 10 to 25% cash on cash. Whereas if you bought all cash, you might be earning, 4 to 10%. Now, you can trade on margin in the stock market, and I think Robinhood even allows somewhere between 2 and 3 times your money, which is awesome. But this is also short term, whereas you can take out 30-year loans at very low interest rates and have your tenants, through rent payments, pay that mortgage down, building equity as well over the long term. And so due to that inability to use leverage to purchase REITs, well, your return is going to be substantially less through a REIT versus property that you would buy yourself. Number 3 is there's no real value add potential. Now, you might have REITs that focus on distressed assets. However, most purchase large A-class buildings. Their goal is to pay out that consistent cash flow and take a percentage of the profit. And so they can't really handle any up and down swing or negative cash flow, whatever. They want that consistency so they can pay out that consistent dividend. However, one great benefit to owning real estate is the ability to find great deals on the market or off market, substantially undervalue, and then purchase them, do a small cosmetic renovation, and add substantial value to these properties, increasing your equity and your net worth. And it's not unheard of to make $20,000 to $100,000 on one deal. You can then refinance those properties, cash out, and use that money to purchase another deal. And so that really accelerates your wealth. And that's one reason why a lot of millionaires are created through investing in real estate. And so this is a huge wealth building benefit you really miss out on when you're just purchasing into REITs. 4 is no real tax benefits to investing in a REIT versus investing in rental property yourself. Now, we already talked about depreciation, which is a huge tax benefit for real estate. However, when you sell stock in a REIT, you pay short-term or long-term capital gains on it, which can range somewhere between 15 and 20%. However, if you owned that property yourself, you could do what's called a 1031 tax-deferred exchange. And therefore, you take whatever profit in, say, a duplex, and when you sell, you roll that profit into another like-kind property, so another duplex, for example, or a 4-unit or a 10-unit, whatever. And you don't have to pay taxes on that profit until you sell maybe the next property and don't roll it into another property using a 1031 exchange. However, you can also defer those taxes indefinitely by continually rolling them over, and then your children can actually inherit them, and when you pass away, the tax basis is stepped up to current market value. You never pay taxes. Outside the scope of this video, but the point is, huge tax benefit, being able to continually roll the taxes you owe into the next property, next property, next property, and use that profit without paying taxes to buy larger and larger properties. And so it just really accelerates your wealth building at that point. Now, with all this said, REITs can still be a pretty decent investment, especially if you understand the pros and the cons, and the investment type aligns with your investment goals. Now, you could consider investing in a REIT using a self-directed IRA or a self-directed 401k, and therefore, as you build your wealth by investing small amounts into REITs, you can then sell and tax-free use that and direct that money to buy real estate. That'd be a great idea. However, personally, REITs don't align with my investment goals because I would rather go out there and buy a great deal off market, add a ton of value to it, and really skyrocket my net worth substantially faster than if I were to just, throw a little bit of money here and there at a REIT. However, that's me. I'm a little farther ahead in my journey, and I'm okay working hard to add value to that property. So there we go, guys. There's the pros and cons to buying REITs. I really appreciate you all tuning in today. Thank you so much. I hope you enjoyed this video. If you did, go ahead and like it and also subscribe to the channel if you're new. I'd love to see you here for future videos around real estate and finance. So thank you so much, guys. I'll see you in the next one.